Picture this. It's March 2020. The global economy is literally in free fall. I mean, markets are collapsing at a speed that honestly makes 2008 look tame. The United States government is desperate to stabilize the system, but they quickly realize they need help. And who do they call? Well, it's not a massive global bank. It's not the Treasury Department. The Federal Reserve picks up the phone and calls an asset manager that most Americans have never even heard of. They call BlackRock.
So, welcome to this explainer on BlackRock, the master of risk. Today, we're diving into how exactly one guy managed to build an absolutely unprecedented financial empire just by mastering the concept of risk.
Okay, let's dive right into this. To really wrap our heads around the sheer, massive scale of BlackRock today, we actually have to start with a totally staggering number: -$100 million. Back in 1986, Larry Fink was this absolute golden boy on Wall Street at a prestigious bank called First Boston. But because his department never bothered to hedge against a sudden shift in interest rates, the value of his mortgage positions literally collapsed overnight. I mean, his department lost $100 million in a matter of months. It was a complete public humiliation. It absolutely destroyed his reputation and led to his very rapid exit from the firm.
And, his fall was just as blindingly fast as his rise. Joining First Boston in 1976 at just 24 years old, Fink had practically pioneered mortgage-backed securities. He was taking everyday home loans and bundling them into tradable bonds. By 1978, his success made him one of the youngest managing directors in the history of First Boston. He felt untouchable, just continually stacking risk on top of risk. But that unchecked confidence, that led directly to the brutal 1986 collapse. The Golden Boy had suddenly become a massive liability.
Now, for most people, getting ousted like that, that's where the story ends. But Fink channeled his absolute obsession with this failure into a brand new venture. He walked away realizing his 1986 disaster wasn't just bad luck. It happened because they couldn't truly understand the risks sitting on their books until it was way too late. So in 1988, he turned to Stephen Schwarzman at the young private equity firm Blackstone. Schwarzman made a calculated $5 million bet on this disgraced trader, giving Fink the capital to build a new firm that would focus intensely on calculating risk in real time long before a catastrophe actually hits.
And what's really interesting here is how they solved that. They built this proprietary system called Aladdin. While the rest of Wall Street in the late 80s was making, educated guesses and relying on really basic spreadsheets, Fink's team was writing code. They treated risk analysis less like a financial art and way more like a hard engineering problem. Aladdin could actually stress test portfolios against thousands of different economic scenarios at once, basically seeing around corners before the rest of the market even knew a corner was coming.
Well, this tech-driven approach worked brilliantly. The firm just exploded in growth. But friction started building under the surface between Fink and Schwarzman. They were clashing over control, compensation, the direction of the firm, which, let's be real, was bound to happen with two incredibly strong-willed personalities who were used to running their own shows. So by 1994, they hit a breaking point and split. Fink's unit was sold to PNC Financial Services for $240 million. Finally freed from Blackstone's shadow, they rebranded as a fully independent company, BlackRock. And by 1999, Fink took BlackRock public, ringing the opening bell as the CEO of his very own firm.
Which honestly sets up one of the greatest ironies in modern financial history. Think about it. The exact same obscure mortgage instruments that absolutely ruined Fink's career in 1986 were the exact ones poisoning the global economy in 2008 and taking down massive banks. But this time around, Fink wasn't the one holding the toxic assets. Because of Aladdin, he was the guy with the analytical tools to actually price them, effectively positioning himself to navigate the whole collapse and save the banks.
Making sense of these massive, complex systems under extreme pressure, whether that's a collapsing global bond market or just navigating your own personal financial and career risks, it all really comes down to a core analytical skill, breaking a hard problem into solvable pieces. Being able to analyze data and probabilities isn't just for Wall Street folks. It's a foundation for reasoning through any complex scenario in life, and that is exactly the kind of analytical thinking that Brilliant.org is built to teach. They offer these highly interactive, bite-sized lessons in probability, data analysis, and financial modeling that take just a few minutes a day. If you want to build the exact kind of analytical instincts that allowed a disgraced trader to turn into the most powerful figure in global finance, Brilliant is a fantastic place to start. You can actually visit brilliant.org/financius for a free trial, and the first 200 people are going to get 20% off an annual premium subscription. All right, so let's jump back into 2008. The financial system is completely teetering on the edge. Bear Stearns gets sold off in a fire sale, Lehman Brothers totally collapses, and AIG is right on the brink. The U.S. Treasury desperately needs to know what the toxic assets sitting on these banks' books are actually worth, but literally no one on Wall Street has the technology to value them at scale. No one, except BlackRock. The government turns directly to BlackRock to untangle the wreckage, because Aladdin, the tool built directly out of the ashes of Fink's own 1986 failure, is literally the only machine capable of making sense of the chaos. So coming out of 2008 as sort of the indispensable savior of Wall Street, Fink sees another massive opportunity emerging from the ashes. Everyday investors are starting to shift away from expensive, actively managed mutual funds and moving toward cheaper, much more efficient index funds. To capture this huge shift, in 2009, Fink pushes his team to act fast. He orchestrates a massive $13.5 billion acquisition of Barclays Global Investors, and that included the fast-growing iShares ETF business, which essentially allows everyday people to easily buy whole baskets of stocks at once. This single, super aggressive move transforms BlackRock overnight into the largest asset manager on the planet.
To really put this into perspective, to show you what their modern scale actually looks like in the real world, think about the entire economic output of Japan, or maybe the GDP of Germany. BlackRock's assets under management, which is the total market value of the investments they control for their clients, exceeds $13 trillion. They manage more money than the economic output of two of the largest, most advanced nations on Earth. Combined, it's almost hard to even wrap your head around.
And here's the thing. With that kind of mind-boggling scale comes immense, almost accidental influence. Because BlackRock manages so much money in their index funds, where they are automatically buying stocks to track the market for their clients, they have quietly become a significant shareholder in nearly every major public company in America. From the biggest tech titans to oil giants to competing banks, BlackRock holds massive stakes everywhere. And that gives them absolutely unprecedented voting power in corporate boardrooms across every single industry, voting power that, frankly, no elected official could ever match.
So Fink realizes he can actually use this seat at the table. He starts writing these now famous annual letters to the CEOs of the world's largest corporations, clearly laying out his expectations. He argued that companies need to account for their broader impact on employees, customers, and the environment. Now to Fink, pushing for environmental and social responsibility isn't some sort of charity. It is macro-level risk management applied to the entire global economy. It's the exact same instinct that drove him to build Aladdin in the first place, just aimed at protecting long-term profitability before future threats can blow up.
But as you might guess, this highly visible stance made Fink a massive political lightning rod. Let's impartially look at both critiques here, because he really does take heavy fire from both sides. On the right, critics accuse BlackRock of using other people's retirement money to impose a political agenda on corporate America, essentially pressuring companies to adopt policies that no shareholder ever voted for. Meanwhile, on the left, critics accuse BlackRock of total hypocrisy. They point out that the firm still profits enormously from the fossil fuel and defense industries, calling the whole sustainability push mere marketing spin. Politicians on both ends of the spectrum have literally dubbed BlackRock an unelected fourth branch of government.
Yet despite all of that intense political heat, when the system breaks down, the government still knows exactly who to call. Which brings us full circle back to where we started, March 2020. As the pandemic completely froze corporate bond markets, the Federal Reserve needed to buy trillions in corporate debt to keep the economy from seizing up. But they simply lacked the internal infrastructure to do it at that kind of speed. So they hired BlackRock's advisory arm to design and execute those corporate bond purchases. BlackRock was literally the only firm on Earth with the technology to stabilize the American economy at that scale.
So what exactly is next for a firm that seemingly already owns a piece of everything? Well, Fink's strategy has always been to identify exactly where the next wave of capital is headed and move in before anyone else can claim the territory. Step 1 was mastering public stocks and bonds. Step 2 was capturing the explosion in ETFs and index funds. And now for Step 3, Fink is aggressively expanding his $13 trillion empire deeply into private markets. We're talking about owning physical infrastructure and real assets that are far removed from traditional public stock exchanges.
Which really just leaves us with this final, deeply provocative question. Should a single private firm hold this much influence over global markets? It is a staggering reality to sit with. A boy from a working-class shoe store family in California, humiliated and practically chased out of his first Wall Street job, went on to build an institution so powerful and so deeply embedded in the global economy that governments literally call it first when the world is on the brink of collapse. It's an incredible story of risk, resilience, and unprecedented scale. I will leave you all to ponder the implications of that immense power. Thanks for joining me on this explainer, and keep actively questioning the systems around you.